IT is doing well. Let's focus on the new kid on the block in that space itself. Healthcare tech solutions company Sagility India saw a flattish listing on D Street, which isn't particularly bad given the sort of market that we're in right now. 30.8 rupees per share, currently holding with gains of almost 6% Ramesh Gopalan, who's the managing director and group CEO at Sagility, joins in now to explain the company's post-listing strategies. Thanks a lot, Mr. Gopalan, for joining in, and congratulations on the listing. It's a 6% up move that we've seen after a flattish opening. The street now wants you to tell them more about the growth that you're planning in terms of the overall business over the next couple of quarters and the trajectory, if you could give us those numbers now.
First of all, thank you for having me on your show. Yes, it's a very proud moment today on getting listed at the stock exchanges. Yes, Sagility is a tech-enabled business services and solutions provider to the U.S. Healthcare industry. We serve both payers and providers, and we've been doing this for 24 years now. So we are a well-entrenched player in the U.S. healthcare sector. We've grown our top line in double digits over the last few years, and we are reasonably confident that we'll continue that growth trajectory in the future as well.
Okay, all right. Hi, Mr. Gopalan, and good morning and welcome to the stock markets. The stock is listed with a gain of around 5.5%, in spite of your Q1 being actually a little bit softish. So could you tell us that revenue growth will pick up yet again? In the past quarter, I think it was 10%. On an average, I think you do low teens. So should we work with that sort of a number? And the rough margin band as well.
Yeah, like I said, our top line growth has been reasonably consistent over the last 3-4 years, and we think it will be in the same range for FY25 as well, right? So every quarter there may be a little up and down, but for the year as a whole, we are confident that it will be in the range. And the margins have also been always consistent. So while you might see a lower reported number in Q1, that's because of a one-time adjustment in a specific earnout expense. If you add that back, our margins are back to the 23 to 25% range, which is the range that we've always been in. And so we are reasonably confident of keeping those margin numbers as well.
All right. So low teens is the revenue growth that you're guiding for, with margins back to normalized levels as well. What kind of investments do you foresee for the company to achieve this sort of low teens growth that you're talking about? Because while you all have listed, the IPO does not bring in some fresh issue or fresh money to the company itself. It has largely been an offer for sale.
That's true. But if you look at our cash flows, we've been generating cash all these years, right? So our free cash flow is in FY24 was $95 million. So we generate enough cash flow to fund our organic growth. And so we don't really need capital raise for funding our growth. And these growth numbers that I'm telling you are all organic numbers. We will continue to look at M&A as a growth opportunity. And if that happens, again, we have funds to support that growth. But we'll have to see the size of deals that we do. But broadly, we generate enough free cash to fund our organic growth.
Taking that point, in terms of inorganic growth, what's the typical ticket size that you look at? And I think you're looking to, more at the US markets. Everyone says India is the hot market. Then why not India?
You in terms of M&A or in terms of
M&A,
the target market?
M&A.
Yeah, so in terms of M&A, we are open to any of the markets, right? So our end client market is the US market as of now.
Got it.
So if we find someone catering to that market with capabilities in India, we'd be happy to look at those acquisitions too. But we've done a couple of acquisitions in the last couple of years, and they've been more capability-focused acquisitions, and so those companies could be anywhere.
Right. In terms of ticket, you said that you have the war chest to actually fund growth via M&A opportunities as well, over and above the cash flows that you use to generate organic growth. If you could give us a sense of how big that war chest is, and in terms of end target market as well, you will stay in the US itself?
Yeah, at this point in time, we intend to stay in the U.S. Like I've told you before, U.S. healthcare spending is the largest in the world. It's about $4.7 trillion, larger than the GDP of India, right? So it's a very large market and it's growing at a healthy pace. And we are still very small in that large market, and the growth for us is very attractive in the U.S. market. So at least for the near future, we will still continue to remain focused in the U.S. Healthcare space. And in terms of the war chest, it depends on the size of the deals that we do, right? So the deals that we have done in the past were sub $30 million, and we funded them organically. But if the deal sizes are larger, then we might look to capital. But at this point in time, we are not sure of what the deal sizes are likely to be in case we pursue fresh M&A opportunities.
Are you in touch with any of the companies right now? Are you pursuing any opportunities that we should hear of in the next, say, 6 to 8 months?
It's very preliminary, right? So we have a in-house M&A team who is constantly looking at opportunities. But right now we don't have anything firmed up yet. So it's very preliminary.
Okay, all right. Your ICRA rating is BBB stable, I think A3 plus. Could you tell us, is there a possibility that you get a rating upgrade from ICRA?
See, the debt that was raised to fund the carve-out transaction from HGS was funded by both equity and debt, right? So, and some of the rating is based on the debt on the parent's balance sheet and not ours. And yes, with some of this restructuring, the rating could improve in the future.
Final question then before we let you go. You did allude to the size of spending in the US healthcare market itself. In terms of your total addressable market in the US with the capabilities that you have, what is that number, if you could give us a sense? And at what rate is that industry growing?
Yes.
What's the market share that you have out here?
So what we do for our clients is the core operational work, right? So the operations spent across payers and providers put together was about $200 billion in CY23. And that is projected to grow to $258 billion in the next 5 years. And so if you look at the growth in the core operations spend as well as the outsourcing propensity of clients increasing, the two put together, industry analysts estimate a 8 to 9% growth in the addressable market for us.
All right. And you don't get impacted by Gen AI?
Yes, Gen AI is likely to impact every industry. And today, we have acquired a company with capabilities in Gen AI. And today we have a number of use cases using Gen AI that we are piloting for all of our clients. And Gen AI is an efficiency tool for us. So we are likely to use Gen AI in a lot of our operations to generate efficiencies. And we will pass back a large part of those efficiencies to our clients and also keep some for ourselves.
I was hoping that clients would come to you for those Gen AI capabilities and not bypass you and do it themselves. And you said that you will pass it on to them. We'll talk about the larger impact of that on another day. Today is a day to celebrate your listing and the near-term outlook that you've given. Low teen sort of revenue growth will continue with the margins adjusted for one-offs will go back to normalized levels. You're looking at capabilities and do not wish to move away from the US market for now, given its attractiveness. With that, we'll shift focus to our special segment. We get you a few ideas.